So, I wanted to ask this to you. The wealth creation study was very inspiring, by the way. It was lovely reading, and this topic kind of gives a good segue into that. So I'll try and combine both of those. But I just thought of asking you that with your relentless focus on QGLP, as we've discussed a number of times as well, and quality across various facets and not just the quality of the management, and if still minefields can creep in to portfolios at Motilal Oswal, how would somebody who doesn't focus so much on all of those aspects still stay safe from these minefields? Because they can really destroy portfolios.
So if you don't take corrective, see, the stock market is a learning process. Continuously you keep learning. I mean, till you die, you keep learning. So there is no end to the learning process. And one of the things is that, as Buffett says, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So how do you ensure that rule number 1, don't lose money? So you don't learn it from day one. There's no way by having even Buffett as your, if he's taking 1 hour session every day, then also you cannot learn not to lose money. In fact, the biggest problem is losing money in the stock market. So how do you not lose, So the filters keep coming, the frameworks keep becoming matured. So you keep looking at the country, looking at your own background, looking at the opportunity in the country, you have to find your own frameworks, set up frameworks. And those frameworks cannot be built one day. When you commit mistake, you try to find, like I committed mistake, or I met with 2-3 accidents in my portfolio. Then I said, let me figure out how do we do it. And the process we have set is, let's make it as a part of wealth creation study so that we can spend 3 months and we'll definitely find some way. So we found our way. And that cannot be 100% proof that we'll not commit mistake again. But instead of having, say, 1 out of 10 times, it should be 1 out of 20 times, 1 out of 30 times. Because, as somebody said, there's only one way to write honest accounts. But there are millions of ways of writing dishonest accounts, and many more million new ways of writing bad accounts are there. So you will not be able to completely avoid, the risk will find you. Risk in the market is what? Risk in the market is the losing opportunities. Yeah.
Well, and multiple ways of losing money via investing into some of those accounts as well. So what's the biggest learning as you did this wealth creation study, and as you look back at, your PMS, I think, was launched, 17 years ago. And we'll talk about that too, by the way, our last question on that. But what's the biggest learning over the last so many years wherein you've seen wealth destruction, arguably in your own mission at times when you started off in your portfolios as well, wherein you had a number of stocks and then you brought them down. But over the years when you've looked at the markets and seen wealth getting destroyed in a very random fashion at times.
So, destruction happens because of the bad managements. Because in businesses, 90% is management, 10% is, as it is said, everything else. So if you don't get your management right, one, you don't make a lot of money. A lot of money will be made by big management. And people come here to make a lot of money. One is that. Second is that you don't buy quality. When you talk about long-term compounding, the compounding can happen only by quality. If there is no quality, it will falter. And if it will falter, it will not work out in the long run in compounding. In compounding, what is most important is, it is not a 5-year game, 10-year game, it has to be 20, 30 years game. You might stay 10 years, but the person who is buying from you at a fancy price, he is looking at another 10 years. And that guy's exit is again dependent on the next 10 years. So whether you want to stay 10 years or not, but the longevity of the company is extremely important in current valuation. So getting the management right, getting the quality of the company right. So all this QGLP, all 4 components, all of them are very important. Like when I met Buffett, when I heard about Buffett in 95, first I thought quality is very important. So I became bhakt of quality. Without bothering of quality at any price. That was the game to start with in 95. Then in 2003, I read this book, Intelligent Investor, which was lying in the rack. I thought this old man, what new things he would have. Our Buffett knows everything. So I didn't bother about that book. So when I read in 2003, margin of safety, when the market collapsed in 2000, then we learned margin of safety. So quality also you cannot buy at any price. So then Q&P came. Okay, then we were practicing Q&P. Growth was in any case part of the DNA. Then in 2014, we realized that G is equal to R. Growth and return is one and the same mathematically. If the company grows at 45%, so in 2014 we did a number, between 2014 and 14, Infosys grew at 43%, and the stock returned 43%. Colgate grew at 11% and it gave 11%. So we realized that G is extremely important. And quality is important, G is important, but then you want to make a lot of money in compounded way. So longevity is also important. So quality and longevity is important in quality, longevity is important in growth. So like that, you're learning. Now, having written QGLP in 14, again, we missed out on the quality of management because we thought it is not numerical and it's very qualitative. How do you figure out? Then we had 2 accidents.
Yeah.
Then we said, let's write it. So this time we wrote this quality of management also. So like you are plugging. Again, we'll commit some mistake in next 1 or 2 years. Then again, we'll find some other method.
Yeah, well, so, you quoted Thomas Phelps in your wealth creation study, right? With the best defense against fraudsters is to run away from them as fast as possible at the first hint of a sharp practice. Now, my question is this, that it's very practical to say this or very easy to say this, but maybe at times a bit difficult to implement simply because you may see that there are sharp practices, but the market loves the business, the stock. You've already created some wealth in it. Let's assume a hypothetical example. What do you then do? Because you are creating wealth, the market loves it, but you've seen that there is a first hint of sharp practice. Yeah. It happens in a number of companies in India, right? So
you read that quote fully, what we have written. So at the first hint of sharp practice, see what happens is, most of the entrepreneurs, they start nicely. They're nice guys to start with. Then little later, the pressure of valuation comes in. For some reason, he wants to show more valuation. And for that, he wants to show more profit, which is not there. Then he thinks that for a quarter, I will do it. Next quarter, the moment our thing comes, we'll be all right. And then the managers have got the permission to do it. They show, the managers, they show them bigger and bigger way of doing it. And if market starts rewarding them, then there is no going away. Like Satyam kept on getting reward and he kept on selling. So, half the folly is that of market also. Market keeps appreciating these guys. Until they punish them, these jokers, the show doesn't stop. So the greed, how do you control your greed? So the moment you see, confirm that, yes, there is a flaw in these books, they are trying to see, this is all interrelated. So what happens is that where this problem comes, there are accounting process. So in accounting, you can do cash accounting or you can do accrual accounting. The moment you start accrual accounting, that is the biggest tool in the hands of management. Now, management can use it conservatively or it can use it aggressively. And in aggression, what happens is, it's a bordering between aggression and fraudulent accounting. So managers, they keep going out into the fraudulent, keep coming back. And at some point of time, they're permanently out. So you have to see, when you see in the books or from any comments or something, it will come to you. When you are holding the shares, somebody will tell you that there is something wrong here. And the moment you get confirmed wrong, run. Because it is going to go to zero. We have seen in this last 24 months, how many heroes have become zero.
That's true.
I mean, global multi-billion dollar enterprises have just disappeared. Yeah. And disappeared in less than 12 months.
Yeah, so some of those risks, Mr. Agarwal, are not necessarily only corporate frauds, right? There is a business risk, and we've seen that over the last 24, 36 months. So how do you identify what's a good point to get out of a business wherein, let's assume it's created wealth. Some NBFCs created a lot of wealth. Then when the IL&FS crisis happened, some of them fell a bit and then have fallen a lot more. It becomes difficult for an investor to accept that, okay, maybe the thesis has gone wrong and this price recession of X, which happened in phase 1, is not all. That there is something beyond it as well, and therefore it might be fruitful to get out. How do you as an investor, identify, try and go about that process?
No, you have to keep it very crude. The moment you're in trouble, run.
But you can't identify trouble a lot of times because there's not a management problem. It's a say a sector-wise or a liquidity risk problem which you do not know when it gets resolved.
So if the business is sound and temporarily is going through some kind of issues, you can take a calibrated call. I mean, management integrity is not in doubt. And okay, they have some kind of a credit cost issue temporarily for 6 quarters, 4 quarters or whatever. That's okay. You have to take a temporary quotational loss. Stock comes from say 1,000 to 500 and again it will go to 2,000, 3,000, 4,000. That's not an issue. I think in a honestly run company, there is no, even Motilal Oswal had a problem. We started Aspire and in Aspire we had a problem. We declared day one, we declared from 1% to 6% gross NP. Market was not happy, but that's how it is. This is a business. So if the management is upfront and forthright in declaring whatever is a mistake, that's fine. Now it is for your call whether you want to back Motilal Oswal or not. So you have to be, and investing is all about long term. I mean, if you believe in the management team, every management team under the sun will commit mistake. Sometimes it is a little bigger, sometimes it is smaller. So you have to, and that's why the maximum money is made by the management team only. Because management team doesn't have option to get out every time. They sit through for 15, 20, 30 years and then they become lucky at some point of time from the market or from the business opportunity or something and you make a lot of money.
Okay. The other aspect of wealth destruction is also the cycles turning against. And again, I wanted to understand from you how easy or difficult it has been for you to identify turns of cycles and not get tempted when I know you focus on value, but at times the price corrects so much that people think that there is value here. So infrastructure, for example, right? The last 10, 11 years after that boom of 2004 to 2008 has hardly created wealth except for a few examples. How do you navigate through such issues in investing?
I think your fundamental, at the time of buying, your buying should be very good. If you're not clear about it, see what Buffett says is that first thing is whether you understand. Whether आपकी समझ है कि नहीं कि भाई this is a good business run by good management. If that understanding fundamentally is flawed, then you are in deep trouble. Because you don't know whether it is right or wrong at later stage. See, when you say understanding, it means when you go wrong, I mean when the signals are coming wrong, still you can say, boss, everything is all right, it is temporary and I will stay on. At the first sign of little bit of weakness in the system, you cannot run. So, but if something turns out to be completely unexpected, you thought that this is like this, but turns out to be very deeply cyclical, or say typically what happens like cyclical companies, well-run cyclical companies, and say commodity price goes from $1 per kg to $5 per kg, and profit is through the roof, and the stock also goes through the roof from 100 to say 1,000. Now at 1,000 you go and meet the management. Typically management says, sir, earlier it used to happen that commodity will come down, but this time the China demand is so massive. I mean, we have scratched the surface and there is no supplier and we are the only guys under the sun to supply. And this 10 actually should be 20. And what happens? It again comes down to $1. I have seen enough of this thing happening. And now, because I got once caught in Sterlite Technologies in 2003 or something when fiber optics came first. And I was very excited that the world is going digital, world wants fiber at home. And it played out like that from $8 to $1. And now second round again it came. And I know them very well. I said, no, it is again going to happen. I don't want to get caught in this. So, you paid your price last time. I bought it 500, I saw 900, and again sold it 100 rupees. There is nothing wrong with the business or the management. It is just the cyclicality of it. So you don't understand, and you have to commit mistake. I mean, these kind of losses will happen, and avoid next time. Don't repeat it again. Don't get caught into this commodity thing going up, and right at the top, all sorts of guys will come, analysts will come, management will come. Suddenly the management who was not willing to meet, they come to your office with a full bandwagon, and they are willing to explain you all the technology underlying. So you got to be very careful.
Yeah, well, I think lessons from history definitely help. I want to revisit something that you had said in a query when we had done that series of the QGLP, power of compounding, power of quality. A question that was asked to you then was that a good business with an average promoter or a good promoter with an average business, what is your preference? You had said then that a good business with an average promoter because a good business is non-negotiable. You still stick to that?
I would revise that.
You would revise that, okay.
Now I would not like to compromise on the promoter. I mean, I can see in promoters you have two things: integrity and competence. Okay, I can say I can take average promoter in terms of competence, but on integrity I want AAA absolutely. I can have an average competent promoter, but not average integrity. Integrity should be a top class. Competence can be average because the tailwind can be very high. If I think, like in banking, if your integrity is top class and you are an average banker and you are private sector, you will meet tons of money.
Okay. What have the last 3 years? I mean, I know you have wealth of experience and we cited so many examples of the past. The last 3 years have been slightly different in that a lot of events got bunched up into India, at least to my experience, whatever. What have those 3 years of, say, observing wealth destruction around you taught you? Has it kind of taught you something new compared to what you always believed over the last 17, 18, 20, 25 years?
So, see, from 2015, what has happened is that earlier you used to buy cheap. If you end up buying cheap, you are guaranteed to make money. That's not the scene now. Maybe so value is out of fashion right now, deeply out of fashion. Buffett Saab is also having tough time. Despite with all his framework and Apple in his portfolio, he's underperforming. So, and 2014, I don't know what got into my head. I was always quality and growth. And this quality and growth, I thought it is going to be our style, but now it has become global style and the market style. And actually at some point of time I realized, QNG, if you find it right, QG and P, if you get it right, it is good for good time and good for bad time.
Okay.
In bad time, see, good time everything is good. But in bad time, only QGP works, which is what is happening now.
So are you altering your strategy, therefore, in that case?
Pardon?
Are you altering your investment thesis in that
No, in fact, I am going more closer to QGP. So what happens is, when manager is wrong on a stock, he becomes a value manager. He bought it as a growth, and then later on he changes the story. Sir, हमने सोचा था 25 का growth आएगा, growth नहीं आया. लेकिन अभी 5 का भी इसमें क्या जा सकता है? Then you are stuck. Don't change the story. The story with which you are bought, please pursue that. You are wrong, run.
So am I understanding this correctly, that over the years, and especially the last 3 or 4 years, due to your observations, you are now not necessarily chasing value. Value is in growth and value is not necessarily in the ticker that you see.
Yeah, so as Buffett said, value and growth, the growth is at the, joint. So, I mean, I was a true believer of that. I always, my DNA is for a little bit of growth in the system. I never liked, because the bucket of value is basically 3 values: breakup value, franchise value, and growth value. And growth value in India is almost like more than 50%. So I always focused on that. The quality was, so to start with, nobody follows quality, I can tell you this. The kids who come from college, or they will want to buy cheap and small and those kind of things. So I also started like that. So quality came because of Buffett, and growth probably is our own, Indian psyche.
Okay. There's one just interesting point that I saw in the wealth creation study, which was interesting as well, that I think you guys have mentioned that if a company is available at the current market cap is at a discount to the sum of the next 5 years of estimated profits, then it's turning out to be a great multi-bagger. Is there something like that which points towards how you can avoid value destruction? Something that is in the company, aside of a bad management, which points towards that let's avoid this because it will take away next 5 years of my profits?
If you don't have that.
Yeah, so if there is something like that, which I should definitely avoid. I know one of the criteria that you mentioned is that if you see a first sign of sharp practice, you will definitely stay away because it could be a wealth destructor. Yeah. Are there other things that during the course of the wealth creation study or otherwise that you factored in, which were obvious numerical or otherwise tools which will help you avoid dubious investments?
Yeah, so far, above 70, 80 P multiples, they never worked. In fact, last year, in last year's study, we ran a lot of data for 20 years and we figured out that if you buy above 80 ATP, typically either outright it is, most of the cases it is outright losses, or you make very moderate return, 5-10% if you're lucky. But that's becoming very difficult. In just 1 year, the whole character of the market has changed so much. The only thing you can buy and make some money is the 70-80 P multiple companies. So it's a upside down. To that extent, I'm still scared of touching something as 70, 80, 100 P. But that remains a still question mark. I think finally people who are buying at 80, 90, 100 as a bucket, one company can definitely be 7 Sigma event or something. But otherwise, you'll not do well.
Okay. I have one final question, and because it will be relevant to a lot of people out here as well, because I heard some people say that they are also portfolio managers, budding portfolio managers, or new portfolio managers. You thought of a PMS as a business or as a scheme at a point of time when it was not as prevalent as it is right now, 17, 18 years ago. What made you think of it then, and how do you think this space will evolve over the course of the next 15, 20 years?
So we didn't have mutual fund license also, and neither we knew, they were all our clients, but we thought it's for big guys. For a small guys like us, we said, if I have to replicate my portfolio for somebody else, then better is PMS. And I was a broking company, so selling PMS through broking outlets was easy. We never thought of a separate AMC and creating all the bureaucracy around that. But that time, even 2002-03, asset management business itself was not that big. It was just about coming up. It was 2003 to 2008 when all these AMCs became 1 lakh crore, 2 lakh crore kind of AMCs. So it's all little later evolution happened. Government also helped, SEBI also helped in making the things for MF much, much better. So now I think the kind of taxation laws which they are putting, they're not, I think SEBI and all in this structure, what actually most of our investors, they want to see and look and feel the stocks. If I put 10% in HDFC Bank and 5% in some other, through the blind pool in MF, they're not that happy. My customer, so many customers in 2008, 9, 10, they took their portfolios. Raamdeo, you don't do anything, why should we pay 2%? We are taking our portfolio. They were very happy to take the portfolio away. That is not possible in MF. Somehow, liking for a direct stock in their name is a lot there. And that's where the PMS comes. Second, I think SEBI has come out with the rule that PMS manager cannot be mutual fund manager. So that fungibility, so if I am a PMS manager and I do only PMS and I'm a wonderful guy, so then the customer doesn't have any choice but to come to me. So now they are making a difference between the taxability of PMS profits and mutual fund profits. That will kind of handicap a little bit future of PMS. Because if my taxation is same, then I want to go to Raamdeo. That's it. Or I want to go to Mansion Thalia, whosoever is a great guy. Because in equity, it's all about the manager. And manager's process, his philosophy, his behavioral, makeup, his experience. जो हमने tuition fee भरा है, सबने थोड़ी भरा है,
Okay. It was lovely chatting with you, Mr. Agarwal. Thank you so much for taking the time out and speaking.
Thanks.